stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So check it out. Now is the time while you're waiting. You're good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. But they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. Don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ stock update for August the 24th. Thank you for joining us today. We have a couple of really good stocks to talk about. CDW Corporation and Cerner Corporation are the two NASDAQ 100 stocks that we're going to focus on. Every day we focus on just a couple of different stocks and talk about the valuation, the dividends, the ESG, and the insiders that are buying and selling with these different stocks. So without further ado, let's go ahead and get started with the two companies that we're talking about. All right, as we look at what we're going into today with CDW and Cerner, we throw the spaghetti graph up here, and we can see what they did today with the market. The NASDAQ was up about 0.6% for the day. And you can see that CDW and also Cerner followed pretty close to it in itself. CDW is in blue, and if you follow my cursor here, the dancing cursor, you'll see it. It started out the day pretty good. And we see on the opposite side of it was Cerner Corporation. And let's talk a little bit about what these companies did. As we look back over the past 6 months, we can see what's happened from February to March. And if you follow the dancing cursor, you can see what happened with these two stocks in relation to the NASDAQ 100 as we go through here. Now, the interesting thing is you can see the profitability and the lack of profitability in some certain instances. If you look at Cerner Corporation is a healthcare IT company. If you go into the hospital and you have billing, that billing is probably done through Cerner Corporation, then is communicated from the hospital to your insurance company so they can get paid. CDW actually supplies a lot of the tech things that are going on with larger companies. When I say tech things, that's not a very technical way to look at it, but CDW is the kind of company that supplies notebook computers. They supply the software, and they don't leave it up to the individual corporation to do it. They're their inside IT and hardware entity. Today, CDW ended up pretty good. It ended up about 1.19%. We've talked a little bit about what some of their strengths are. And I want to go back and look at what their earnings were. They had an earnings call, which was on August the 6th. And actually, it really wasn't that great. It was 5.7% lower for the second quarter sales. The operating income was down, as was the income per share was down as well. When we talk about the profitability of these companies, we refer to their profitability in the terms of a moat. Now, you might be asking yourself, what's a moat? And if you followed me in past days, you already know. But here's a very good description of what a moat is. A moat is the sustainability of profits. When we look at a company like CDW, CDW does not make anything. Basically, they are a sales force in itself. Now, they do have a lot of profit, a lot of products. If you looked at the slide previously, you saw that they have well over 100,000 different products that they offer to companies. They offer tech services along with that. They serve primarily mid to large size companies that don't want to delve into the direct they don't want to dedicate the individuals or the department to that particular area of the software in itself. They have a diversified clientele. It goes from hospitals to schools to it's just a wide range of different products. The thing is about with CDW also is that they actually don't sell an individual product that they make. They sell everybody else's products. So that gives it a very narrow moat. When I talk about moats, if you have a wide moat, that means that you've got a lot of profitability. When you have a narrow moat, you don't have as much profitability. Because really, if you look at who the competitors are with CDW, it's going to be the manufacturers directly. If you looked in the Wall Street Journal and you ask, it'll have a reference under CDW as what the competitors are, and it'll list a company like Apple. Well, Apple and CDW they sell products to businesses, but they're different from that standpoint. CDW will sell Apple products to businesses and represent it. They'll be the middleman, so to speak. If we look at what happened with CDW from an individual standpoint, I'm going to tell you a little bit about the time frame. Where you see the cursor going around is from in between January and March. And then as we go further up, what we're going to do is we're going to take a look at the volatility of this particular stock. Now, the way that you measure volatility, or the way that it's measured with investments, is in comparison to the Standard & Poor's 500. If a company has a more volatile stock than the S&P 500, they're going to have a higher beta. Beta is just a name that they've given to this particular statistic. The beta for CDW is 1.1526. And what that tells us is that it's about 15% more aggressive or more volatile than the S&P 500. And if you look at the line, you can really see the difference between the two. The red line is the S&P 500, and then CDW you can see was actually more volatile than the S&P 500. So that's why that it has a higher beta in itself. Now, when we talk about valuation, this is a number that's put out by Morningstar. And it's really interesting because Morningstar actually has an algorithm that calculates this for some companies. They do have analysts that do live reviews of some stocks, but not all of them. There's just too many stocks out there. There's around 5,000 stocks that exist, and they just can't cover every last one of them, even those that are in the NASDAQ 100. So if you look at CDW, the numbers that I'm going to report to you are calculated based on an algorithm. And what the algorithm tells us is that the fair market value of CDW is right at $100 per share, 100.002. The last close today was 112.09, and they only give it 2 stars. If you look up the valuation on Morningstar's website, you're going to see a Q beside it. And what that Q means is that this calculation, or else this data was calculated based on an algorithm, not based on a real person actually looking at it. So in circumstances like that, you need to take a little bit closer look at what's going on inside of the company. Now, one of the other things that I encourage people to do is to look at what the insiders are doing, the people that are working for the company, the people who are executives for the company. Are they buying and are they selling? That's a good indicator as to perhaps if it's overvalued or undervalued most of the time, but there's very few absolutes in investment analysis, and insider data is one of them. What do I mean by that? What I mean is, if you look at this, you see that there are a large number of buys. You look at the last 3 months, there were 360 shares traded and there are 11 buys. And in the last 6 months, there was a little over 10,000 shares traded and 35 buys. But here's the part that's really deceptive. I want to show you this on the next screen. If you look very closely at the number of shares that were traded, they're small. The people that are trading are really not what you would consider the executives of the company. These are actually board members that are buying shares for whatever reason. So you wouldn't really want to take this as an indication that it's undervalued and purchase more just based on the fact that there were a lot of activity going on inside of the company. You can see that one of the directors, James Bell, bought 45 shares. Benjamin Cheerskin bought 23 shares. That's not really a whole lot of shares. It was just some activity that was going on. And when you go back to the last slide and you see, wow, there were a lot of people buying this stock that work for the company. It must be undervalued. I think that that would be a false positive. The reason it's a false positive is because these are minute numbers that are working. When we get to Cerner Corporation in a moment, I think you'll see more substantial trades that are happening. Now, one of the best parts about this particular stock is it pays a dividend. Now, for people that are retired, I want to talk to you directly just for a moment. You may ask yourself, since we are focused on retirement and helping people to plan for retirement, why do we talk in this particular live stream so much about the valuation and about the stock values of individual stocks and stuff? Are we encouraging, does that mean that we're encouraging people to go out and buy stocks and trade them in retirement? No, not at all. The idea is that stocks, if you have stocks in retirement, there's primarily 3 different reasons that you'll own stocks. Number one, owning stocks in retirement is going to be for their dividends. And the 2 stocks that we're looking at today, CDW and Cerner, do pay a dividend. And that's an important thing. If you're retired and you're looking for income, these are the types of stocks that you might want to put into your portfolio because they're high quality stocks and they pay a dividend. Now, there's going to be volatility and of course there's going to be risk, and you need to look at it individually and make sure that it fits to your risk criteria and it fits you. So I'm not saying making a recommendation to you because I don't know you. If you want to learn more about how to do this, you can contact me and we can talk about it to your particular circumstance. But I can't tell you specifically just by a live stream here today. But nonetheless, that was one reason. I told you there's 3. Number 2 is going to be growth. And I've talked about this in days past. If you've watched the live stream in days past, you've heard me talk about different types of strategies for taking income. And one of those strategies is called bucketing. The way that bucketing works is that you create certain time frames where you'll utilize money for the future. And if you use bucketing as a strategy, using stocks, growth stocks is a great way to fund buckets. Let's say, for example, if you retired today and you expected to be retired for 30 years, you have to think of what am I going to do not only today for income, but what am I going to do in year 20 through 30? That's where stocks can still play a part. Now, for everybody, it doesn't fit. There may be some of you, and I have some of you that are clients that stocks are not the way that you should be investing. And that's okay. It just depends upon you individually. Now, the third reason, you heard me say that there's 3 reasons that people in retirement buy stocks. Now, don't be too shocked about this, but I'm going to tell you, there are a lot of people that buy stocks just because they like to buy stocks. They like the entertainment aspect of it. Yes, I said entertainment. And I'll give you a very short example. I had a client that at one point in time, she was retired. She liked to go off and play tennis 3 days a week and had a great retired life. Her husband had passed away and left her quite a bit of money. And I helped her to manage that money. But she liked to watch CNN in the afternoon and get the stock updates. And she would call up a discount broker. At the time, the internet wasn't really popular. She would call up a broker and they would trade different penny stocks because she liked to do it. Remember that the idea of trading stocks is that it can be it can be intellectually stimulating because you're thinking of how this company works and what's working and how it's not working. So it is an interesting thing to do. And if that's something that you like to do, I think that's great. You can take this information and use it however that you would like to use it. But here's the part that you need to pay attention to and be very, very careful of. And I had this conversation with the client that I mentioned to you. The conversation was this. She started to go into her regular income accounts and draw out money to trade stocks. And on a review, we started to talk about how that was impacting her income. Her income was starting to go down because she was trading stocks, but she wasn't making money, but she liked trading stocks. So what we did is we set up a budget and said, this is the amount of money that you can spend. And after you spend it, it's just as if you had gone into a casino and said, I'm not going to spend any more than this. And that worked out great. So there are 3 reasons, remember, that retirees can utilize stocks. 1 is going to be dividends, 2 is going to be growth, and 3 is going to be for the intellectual stimulation. And it's valid. It's a valid thing to do. So let's go back to where we were talking just a little bit today. All right. Let's go into the next company and talk about Cerner Corporation just a little bit. I enjoy doing these live streams because I think that I'm offering you some education. I'm giving you some information that you may not have known before. You probably, if you're just an average person out there watching this, you've probably never heard of Cerner Corporation. But Cerner Corporation is one of the largest NASDAQ stocks that exist. Cerner Corporation, what they do is they take care of the IT, the billing, everything for a lot of hospitals. A quarter of the hospitals on a worldwide basis utilize Cerner Corporation. And they have a big foothold into the dissemination of software information, of IT services for the medical industry. Now, if you've watched this in days past, you've heard me talk about a company that has a wide moat. Remember, if you were watching just a minute ago, you knew that when we talked about CDW, that CDW has a narrow moat. However, if we look at a company like Cerner Corporation actually has a wide moat. Remember, this is what a moat is. Remember, a moat is the sustainable profitability of a company. Now, the reason why that Cerner Corporation has a wide moat is because it's very, very difficult for a hospital system to switch IT services. Think about it from this standpoint. They have the responsibility, actually the legal responsibility under HIPAA, which is a federal regulation, to keep track of the data and to keep it safe. And Cerner Corporation is a key component to that. It's not as easy as just saying, I'm going to go from using Chrome to using Edge. It's more difficult than that. You have to dedicate the personnel to making the change. You have to dedicate the money to making the change, of training people of how to do it. And then you have to be able to transfer the data from one software system to the other software system. So the benefit that Cerner Corporation has is that its service is very sticky. That means that it's difficult for companies to leave. Now, they offer a good service or else they wouldn't be around for as long as they are, but they do have a wide moat. They don't have as much problems from competition from that standpoint. So let's look at a few other aspects of Cerner. Oh, wrong button there. But let's get a little bit further on here. Okay, let's look at what the valuation is for Cerner Corporation. Now, you heard me talk just a few moments ago about CDW, how CDW, the valuation was done by an algorithm. Well, that's not the case for the Cerner Corporation. Morningstar is actually dedicated an individual that actually looks at the details of the company in itself, and an analyst will take more detail and care in looking at it. So this has got a little bit more validity to it. Actually, I'd say it's got a lot more validity to it than the information that is supplied for CDW. When we look at the valuation of this company, Morningstar rates it as a 3-star company. Now, remember, when we look at the star system for Morningstar, this is not like you're going to a 4-star restaurant where you're going there because they've got a good product. Morningstar is not trying to tell you that this is a great stock, you should buy it, there's a lot of potential to it. What they're telling you is the valuation of that stock. Now, the valuation that they are telling you on Cerner Corporation is that it's a 3-star stock, and that the fair value of the stock is $78, and it's actually closing under what the value is. The last close was $72.36. That was today, and the fair market value was $78. So that's the difference between the two. Now, if we look at what is going on with the value over a period of time, and we compare that to the Standard & Poor's 500, that's how we get that volatility measure in there. Remember a few moments ago when we talked about CDW, how CDW was about 15% more volatile than the S&P 500. But what you see here is that Cerner Corporation is actually about 13% less volatile than the Standard & Poor's 500. Now, how could you use that information? That's very valuable information if you don't want your value of your money to fluctuate a lot. If you're looking for higher dividend paying stocks, but you don't want to have as much fluctuation in value, well, if you were comparing one stock to the other, then you might be more attracted to Cerner Corporation because they pay a dividend, but they're not quite as volatile. On the other hand, you may be looking at a company like CDW because they have a little bit higher dividend, and that's what you're looking for, and you will tolerate the higher volatility that's associated with it. So it's just information that you can use to help you to make decisions. This is not buy or sell recommendations, but it's information that you can use that will help you to make better decisions. I've talked a little bit about the dividend history, and if you look at the dividends of Cerner Corporation, they pay a 1% forward dividend. So you'll see that if you are a retiree and you're looking for dividend paying stocks, this might be one to look at because it's paying about a 1% dividend, and it's a little bit less volatile than the Standard & Poor's 500 as long as we go with the beta number. Now, I've got to stop for just a moment and tell you this really, really important information. I'm giving you information about these stocks, but I want to reiterate that this is not buy-sell information. This is not saying, hey, go buy this based on this, or go sell this based on this information. The only way that can be done is if you and I have an individual conversation and I talk more about what your individual needs are. You talk about it and you tell me about that. If that's something that you want to get my assistance on, then go to my website at richardsfinancialplanning.com and you can sign up for a time where you and I can have a conversation about your individual situation and how the stocks today or group of stocks can be utilized to help you with whatever financial goals that you might have. Now, it might not be just one stock. It might be a group of stocks. And I'm a big fan of using the technique called direct indexing. And we're going to talk about direct indexing next in the relationship of companies that have ESG attributes. Now, what do I mean by that? ESG is environmental, social, and governance. There are some people, and you may be one of them, that are very conscientious about the way that you invest your money. You don't want to invest in companies that are serial polluters, Or perhaps if you're a vegan, you don't want to invest in a company that does animal testing. Or if you're Christian, you don't want to invest in a company that supports abortion or something related to that. If you want to buy an index, you don't have any say-so over which stocks are there. You just basically buy the index. But if you use direct indexing, then you buy the stocks that are in that index and you draw out the stocks that you don't like. You draw out the ones that are doing animal testing. You draw out the ones that are related to nuclear power, if that's something that you don't want. Or you draw out the ones that are involved in abortion, if that's something that you don't want. So direct indexing can offer you a lot of advantages from that standpoint. Okay, so let's get back over to what we're talking about with the two different stocks that we are discussing today. With Cerner Corporation, I mentioned to you just a moment ago about the insiders that were buying and selling with CDW. And we looked at the fact that there were just some small trades that were going on, not big trades, but small ones. And it was what I refer to as a false positive. You saw a lot of buying activity, and you might think, hey, this stock's undervalued because insiders are buying. Not true in that situation. Because, why? Because they were small transactions. So they were immaterial from that standpoint. Now, if we look at the insiders buying and selling that's going on with Cerner Corporation, it's a little different story because the insiders are trading more value. And this really is not telling us a whole lot. I think if anything we learn from looking at the buyers and the sellers for Cerner Corporation is that it's a pretty stable company from the standpoint of value. Or I would say that's what the people working there have as an opinion. The reason is there's not wholesale buying or wholesale selling that's going on. If you look at the last 3 months, we had 9 buys and 9 sells. And if we look at the last 6 months, it's 25 and 20. And the last 12 months, it's 64 and 42. Now, if we go to the next slide, if you zero in on some of these things, here, see if we can do that real quick. If you zero in on some of these different things, you can see that the numbers are bigger. Okay, so and they're larger. You can see that there was some trading that's going on that's just a little bit bigger than previously. So it does make a big difference from that standpoint. And when we talk about it from that viewpoint, I think that you can get an idea that there's more people buying and selling that are substantial. And remember, previously, my thoughts are that it gives an indication that it's a fairly stable company because we don't have owners running for the doors to sell stocks. And we've seen that in past days with other stocks that we've looked at. So let's move on to the next aspect, which is the ESG and the BRI. What is ESG? ESG is the environmental, social, and governance attributes of companies. Now, if you look at the chart that I've thrown up here on the screen, you can see that there are some companies that have positive attributes, some that have negative attributes. On the top, if you follow the cursor, you can see that there are companies. This is a list of companies that are in the NASDAQ 100. You can see that there are 3 companies that are involved in nuclear power, 3 that have GMOs, 3 that create weapons, 11 that do animal testing, and then the list goes on down. You can see which ones are there. If you want to look at it more carefully, just freeze it on the replay, and you could look at this to your heart's content. But as we move on and we look at the 2 companies that we're discussing today, with CDW, I want to go over to MSCI and see what their opinion is on the ESG of this company. I know I'm throwing around a lot of different acronyms here, but remember, ESG is environmental, social, and governance. MSCI is it's Morgan Stanley, essentially. It's a rating service that rates companies, and one of the rating services that they offer is in ESG. They do an excellent job of determining the ESG. They do a deep dive and investigation into the companies and the ongoing that's going on inside. They rate CDW as a double B. You can see what the scale is here and get an idea. In past days, if you followed me, you know that there are actually some companies out there that are lower than this. And if you have a concern about ESG, you probably want to stay further away from companies that are on the lower end. The companies that are on the upper end may be more attractive to you from that standpoint. If we look at individually what MSCI is saying about CDW is they say that they are lagging because of controversial sourcing, and they're basically overlooking different opportunities to have clean technology. So if you look at it from that standpoint, if you are more concerned about, let's say, animal rights or about the environment, you might want to look more deeply at what's going on at CDW if that's a company that you do want to invest in or a company that you don't. Now let's go to the next aspect, which is the biblically responsible investing aspect. Now, some people in past days have said, what does BRI mean? I've heard of ESG, but I'm not familiar with BRI. Now, real quickly, I'm not going to get into the biblical aspects of it. I'm just going to quickly go down and tell you this is what I'm reporting when I'm telling you about BRI. I'm telling you about how the company, from a Christian standpoint, takes care of the customers, how they deal with the community, how they deal with the workforce, and their worldview. That's what we're looking at. Now, the company that I utilize that gives the report on this is called Inspire. And they rate companies on a scale between 100 as a plus, and then on the negative side, negative 100. So if you're on the negative aspects of it, then you would say that they're probably not a biblically responsible company when it comes to investing, or they may have some issues that are involved in there. Now, you want to look at it individually, and I don't go through the individual aspects here, but if you want to learn more about it, you could send me an email to van@richardsfinancialplanning.com and say, hey, I'm interested in the BRI attributes of CDW. And could you give me more information on it? And I'll send it to you. I'll do the same thing with Cerner Corporation that we're going to talk about in a moment. But remember, we were talking about the scale between 100 and negative 100. The pluses are on the good side. That's the way that we look at it. So Inspire has a positive 58. So they would be considered a biblically responsible company. If we go on and we look at Cerner Corporation, we'll look at the MSCI rating first. They're very highly rated when it comes to the opinion of MSCI. They're a AA company rated by MSCI. And when we look at the individual attributes, this shows you that really, as far as human capital development, that's the only negative attribute that they have. They have a lot of other positives that are there. For a company that's an IT company, they're a leader in one area that's the most important one for them, which is going to be privacy and data security. So that's extremely important. And that would be related to the governance of the company. So when we're looking at ESG, this would be the G part. When we look at the biblical responsible aspects of it, they're a highly rated company from that standpoint too. They rated a plus 41. Again, if you want more information on the BRI of these companies, just send me an email to van@richardsfinancialplanning.com and refer to the company that I talk about here, or whichever one that I've talked about in previous days, and I'll be glad to get back to you and answer whatever questions that you have. That's the end of everything that we have for today. Remember that the primary purpose of my company is to help clients retire without running out of money. And if that describes you, if you're interested in that, go over and visit my website at richardsfinancialplanning.com, and it'll tell you a little bit more about what we do and how we do it. And then if you want to talk about that, if you want to talk about retirement, or you want to talk about the investments that we've talked about today and how they might relate back to your circumstance, sign up for a time to have a conversation with me. It's about a 15 to 20-minute conversation. It's free. All you need to do is go down to the little teal button that says schedule a call to learn more. You click on that. It'll bring up a calendar. You pick out a date, and then you just leave your phone number. I'll call you, and we'll have a conversation about your issues and take it from there. So with that, I believe that's everything that we have for today. So at the very end of this, there's actually a disclosure that's extremely important. Stick around, read it. If it goes by too fast, then freeze it on the replay and take a look at it. Thanks for joining me today, and I will talk to you tomorrow.